Welcome back to the Deep Dive. Today, we are cutting right through the noise of earnings season to focus on one company, Dynex Capital, ticker DX.
Right. And this was a fascinating quarter for them.
It really was. It felt like a tightrope walk. So we've gone through the earnings script, the Q&A, all the financial tables to really figure out what happened here.
And it was, a quarter of conflicting signals. I mean, on one hand, you have this tremendous operational success, massive capital raises, fantastic growth in their asset base and book value.
They really put their money where their mouth is.
They did. But then on the other side, you get this core earnings volatility, a headline miss that it seems to have kind of overshadowed everything else.
And that's our mission today, isn't it? To distill this Q3 2025 report and figure out why management is, in their words, cautiously bullish, but the market just sort of shrugged.
Exactly. The stock closed up, 0.37%?
Barely moved. For a company that delivered a double-digit economic return in 3 months, we have to figure out that disconnect between the asset success and, well, the stock price apathy.
It's a classic AmREIT puzzle, right? The market wants that predictable, short-term core income, even when the long-term value creation is just phenomenal. And Dynex gave us a masterclass in that this quarter.
Okay, so let's start right there with the snapshot of the results, the big numbers.
So the first number everyone saw was the adjusted earnings per share, 25 cents.
Which was a miss. The consensus was hovering around 31 cents. So that 6-cent gap, that's the disappointment everyone latched onto.
Correct. And that's what hits the wires first. But, and this is a big but, if you look at their actual interest income engine, the net interest income, or NI.
They actually beat on that metric.
They did. They reported $30.6 million in NII, which was ahead of the $29.3 million consensus. So their core spread business made more money than expected. It's just that the adjusted EPS number got hit by some other more volatile items.
That's a critical distinction. But here's the number that I think really tells the story of the quarter. The book value per share, the BVPS.
Absolutely. If you only remember one number from this deep dive, this is it. Book value per share climbed to $12.67.
That is a huge increase, a 72-cent jump just quarter over quarter.
It is. And when you add the dividend back into that, you get a total economic return of $1.23 per share. That's a 10.3% return on their starting book value in just 3 months.
A staggering number. That's a brilliant asset stewardship. And a big part of that was issuing stock above book value, which... Can you just simplify how that actually helps existing shareholders?
Sure. Think of it like this. Say the company's assets, its house, is worth $100 per share. If they can sell a new share to a new investor for $110, they bring in that cash, and the extra $10 they got above the current value gets spread out among all the shares, old and new.
So everyone's slice of the pie just instantly got bigger.
It's a wealth multiplier. That's what accretive means. And it's a real compounding machine for these companies when they can pull it off.
And they did this while keeping the dividend steady. They declared 51 cents per share for the quarter, which is that 17 cents a month payment. So you got that BV growth and the stable yield.
Which brings us to strategy. How did they actually do it?
It wasn't an accident.
No, not at all. This was aggressive execution of a thesis they call raise and deploy. Management had been saying since 2022 that the opportunity in Agency MBS right now is generational. They saw mispricing, and this quarter they went all in.
And the scale of that deployment was just immense.
It was. They raised $254 million through their at-the-market program, their ATM.
Yeah.
And as you said, all of it was done at a premium to book, so it was immediately accretive.
And what did they do with that cash?
They put it to work. Fast. The portfolio grew over 50% year to date and 10% just since the end of last quarter. That is lightning fast growth.
Oh, yeah.
They bought $2.4 billion of agency residential MBS and another, $464 million of agency commercial MBS. They are just leaning into these government guaranteed assets.
So that buying spree directly fed the BV growth. But it wasn't just the new assets, was it? The macro environment gave them a huge tailwind.
A huge one. Two things happened. First, the 10-year Treasury yield came down a bit during the quarter. And second, maybe even more important, MBS spreads got tighter.
Which means the bonds they already owned became more valuable.
A lot more valuable. It led to over $130 million in portfolio gains in Q3 alone. Just a perfect validation of their market call and their timing.
And they did all this while keeping leverage in check.
Very disciplined. They ended the quarter at 7.5 times leverage. And, it's important to note that number includes their TBA commitments.
The to-be-announced forward purchases. So it's a more conservative, complete picture of their risk.
Exactly. And even with all that growth, their liquidity is still over $1 billion. That's more than half of their entire equity base. Super robust.
I also thought it was interesting how they talked about their bias toward lower coupon bonds. That specific thought paid off when mortgage rates dipped mid-quarter. It shows a really granular approach.
It does. It's all part of this expert risk management story they're telling, which brings us to what they see coming next. What's the forward guidance?
Well, they sound pretty optimistic about the Fed. They're expecting a 25 basis point cut in September 2025, and they called that a tailwind for their net interest margin in Q4.
Because it lowers their cost of funds, makes their borrowing cheaper.
Right. But here's the challenge, isn't it? Are they just trading a lower cost of funds for higher prepayment risk? If mortgage rates fall, more people refinance.
That's the key question. And they acknowledged it. They said they're bracing for faster prepayment speeds because of that rate drop in September.
But they don't see it as a threat. They see it as an opportunity. They said they're using that volatility to find alpha, or above market returns, by picking specific bonds within the coupon stack.
And for our listeners, the coupon stack is just all the different interest rates on the mortgages they own. So what they're saying is, yeah, rates are falling, but we can find pools of loans, maybe low balance loans or loans in certain states that we know from experience won't prepay as fast as the rest of the market.
That's where the expertise comes in.
That's how they plan to generate that alpha.
And their defense against bigger shocks is pretty robust, too. They talked up their hedging with futures and swaps. Their focus on only highly liquid assets. They're even opening a New York City office to get more trading talent. They're building a fortress.
Right. And while they're building their own fortress, they spent a lot of time on the call talking about the risks they see elsewhere. They use this great balloon analogy.
Yeah, that you squeeze risk in one part of the financial system and it just pops up somewhere else.
Exactly. And they named where they see it popping up. Private credit.
The hidden leverage.
Precisely. They pointed out that unlike them, private credit funds don't have to mark their assets to market every day. And they don't have the liquidity. So you have this huge opaque corner of the market where you won't know there's a problem until it's too late.
Until the music stops.
And they were pretty blunt about it. They're watching cracks in consumer credit, like auto loan delinquencies, and said private credit markets offer very little, if any, margin of safety right now. That macro pessimism really explains why they are so focused on liquidity.
Okay, so let's bring it all back together. They had this incredible quarter on the asset side, accretive capital raise, huge BVPS jump, a clear and defensive strategy. So why the muted stock reaction? Why up only 37 basis points?
It gets back to what the market really wants to see from these companies. Investors are just focused on durable core earnings growth, the kind of earnings that you can count on to cover the dividend month after month.
So they see the big economic return, they acknowledge it, but they're waiting for it to translate into higher sustainable cash flow.
That's it. They want proof of concept on the earnings side before they're willing to re-rate the stock and let it trade up to or above its new higher book value.
So what are the current numbers telling us? The Q&A had some good tidbits.
It did. Management gave an updated BVPS estimate, quarter to date, of $12.71. That's even after accounting for the latest dividend. And they confirmed returns on their assets are still really strong high teens, net of hedging.
There was also that really interesting back and forth about spreads, which I think is key to why management is so bullish.
Yes. So on the surface, spreads versus the Treasury curve look a little tight.
Which suggests less profit to be made.
Right. But management pushed back on that hard. They said if you look at spreads versus interest rate swaps, which is what they actually use to hedge, those spreads are still near the top quartile of historical levels.
And that's the metric that matters for their actual bottom line.
It's everything. Because they hedge with swaps. That widespread provides, in their words, a nice buffer for carry. They really believe their model is the best way to capture that spread over time.
So they see this huge opportunity that the market isn't fully pricing in yet.
Exactly. And that brings us to our favorite segment. This is not financial advice, where we just sort of kick around some ideas based on what we've heard.
Purely academic, of course, for entertainment purposes only.
So here's the setup. You have a company that's raising capital above book, generating double-digit returns, and they're screaming from the rooftops that their asset class is still cheap. But the stock is just sitting there, barely moving.
Okay, I see the disconnect. So what's the play?
I'm calling it a leveraged book value convergence play. The idea is you go long DX equity, betting that the stock price will eventually catch up to the rising book value and that $14 average target price.
But you need a hedge against the whole sector going down.
Exactly. So at the same time, you short a broad, lower-performing mortgage REIT ETF, something like REM.
Right. REM's one-year return was way lower than DX's. So you're hedging out the general market risk and just making a pure bet on Dynex management's execution.
It's a bet on skill, a clean, isolated bet. But now, for the outrageous twist.
Let's hear it.
This is where we leverage management's own pessimism about that systemic risk balloon.
The volatility hedge.
You take a very small piece of your capital, like an insurance premium, and you buy some deep, out-of-the-money put options on the S&P 500, or maybe some VIX futures. You're making a direct bet on management's warning about hidden leverage in private credit, about the market ignoring geopolitical risk.
You're betting that if that AI hype finally cracks and their tail event actually happens, that tiny insurance policy pays off in a massive way.
The ultimate return amplifier.
Yeah.
It connects their macro view directly to a trade.
So to wrap this all up, what's the one key takeaway?
I think it's that Dynex delivered a fundamentally strong quarter. They prioritized stewardship of book value, they deployed capital aggressively, and they believe this environment gives them a structural advantage, even if core earnings are choppy right now. The whole story is that tension between high book value and lower EPS. And that leads us to the final provocative thought. Management said the market seems to be cutting tails out of the expected outcomes, basically pricing out the possibility of extreme events, the very risks they're warning about. So given their belief that the big money in this sector gets lost or made during periods of extreme volatility, the question for you, for everyone listening is, what major market risk do you believe investors are currently underpricing?